In today's video, I'm going to see if I can make a point about recency bias. So this particular chart is gold. Um, Gold has been stuck in what I think is probably the handle of this cup and handle pattern for, since late 2020. So people, traders, investors have now become convinced that since gold hasn't really been able to do anything for almost 3 years, that just means that it's never going to do anything. Well, let me show you not only this market but several others where people had the same view. An extreme case of recency bias. Because it hasn't done it lately, it means it can't do it. So gold had been in a bear market since the bubble burst in 1980. And this, in 2000, 2001, it had been 20 years since gold had done anything. And of course, that meant that gold could never do anything. It was never going to go anywhere. It was a dead asset. You're never going to make any money in gold. Except over the last, 22 years, gold has gone from $250, had a massive, massive bull market, one of the biggest ever, and has been consolidating for about 11 years now. If we just kind of assume that we haven't really broken out a sustained breakout above these highs at a little over 1900, we've kind of been stuck a little above, a little below that for about 12 years. So you could kind of almost say that it's been more than 3 years stuck. It's been about 11, almost 12 years stuck, going nowhere. Very, very similar to what happened here. And of course, everyone knew back here in 2001 that gold was never going to go anywhere. So an extreme case of recency bias that proved to ultimately be false, and false on a scale that would cost investors and traders a lot of money. Now let's look at oil. Oil had been trapped below $40 for years and years and years. That, of course, meant that oil was never going to do much of anything. It was just going to bounce back and forth between $20 and $40 forever. Except that also wasn't true. Oil had a huge bull market that basically started in 99, kind of double bottomed, kind of the same as gold. We started a commodity bull market, and oil went from $10 to almost $150. So another case of recency bias being terribly wrong. I tend to think I know we did. We started another commodity bull market right here. This is when oil went to negative, I think it was negative $35. That was the bell ringing for anybody that wanted to listen, that the commodity bear market that started when this bubble topped, and that started the secular bear market that lasted 12 years from this top in 2008 to this bottom in early 2020. But commodities are now in another bull market. So I tend to think this bull market went from $10 to $150. I don't necessarily think we're going to go that far, but I do think oil will ultimately go at least to $200, maybe to $250. And if we don't come to our senses and get off of this insane green agenda demonizing fossil fuels, then it's probably going to go a lot higher. But again, a bad case of recency bias. Since oil hadn't done anything since that top in 2008, it means it's not ever going to do anything. And we've been working our way down into this 3-year cycle low. It's the first major correction after this secular bear market bottom, and now we're just starting the second leg up, the second leg of inflation, which is the inflationary phase is not over. So again, another bad case of recency bias causing people to make an incorrect decision based on what occurred in the past and the expectation that will just continue indefinitely into the future. All right, here's another one. The NASDAQ, bubble top here, bubble collapses, just long period of going nowhere, not even close to recovering those old highs. 12, 13, 15, 16 years, and still nothing. So that of course means that the tech is dead. It's never going to really amount to anything. And back in here, I started telling people that first off, we were going to recover that 5,000. 5,000 was a sure thing, and once we did, 10,000 was going to be a piece of cake. Now, a piece of cake doesn't mean it's going to go straight there. There are ups and downs along the way, and there can be some really scary ups and downs along the way. But a piece of cake means it's going to get there. And I said 20,000 isn't out of the question. Well, sure enough, once we broke out above this, we did have some crazy up and downs along the way, but we got to 10,000 just like I promised we would. And so far, and I don't think this is over yet, we've come fairly close to hitting that 20,000 mark that everybody back here said I was insane. That was never going to happen. But again, recency bias, terribly wrong. Semiconductors, another one, just stuck for years and years and years, couldn't make higher highs. I tried to warn people that once the semis broke out above these all-time highs, it would make a big move. And that's exactly what we've seen. And again, I don't really think that this is done yet. I think we've probably got further to go in this long-term bull market. But there are going to be some scary, crazy corrections along the way. And we've just had one here. We had a big one here in 2020, but I don't think this is done. So another case of recency bias leading investors, especially long-term investors, terribly astray when they should be. You should. When a market has underperformed for a long time, that means it's due to outperform. So you need to jettison the recency bias and look for a change. So now let me go back to gold again. All right, so for the sake of argument, we can just kind of say that gold has been basically stuck since late 2011, and then we've had 3 years here of just a very frustrating sideways churn. However, this I am about 99% sure is an 8-year cycle low. This was an 8-year cycle low, and this was an 8-year cycle low, and then we of course had another one back here with the double bottom in 2001. So for the people that are stuck in recency bias, thinking that gold, because it hasn't done anything in a long time, that means it's never going to do anything, they're going to be wrong, just like they've been wrong at all of these major turning points. And we are now in a period where it is most likely that these people are setting themselves up to be wrong, and they're going to miss a big, probably multi-year move, and in my estimation, it's going to be something along the lines of this, simply because we've spent so much time going sideways. And the rule is the bigger the base, the higher in space. And we're at 13 years now in gold, and we're just starting the advancing phase of a new 8-year cycle. Commodities are in a new secular bull market, and gold is not going to be left behind in a commodity bull market. The commodity complex, the CRB, is just starting the advancing phase of a new 3-year cycle. Gold bottomed a little ahead of the CRB. The CRB bottomed back in of June of this year, whereas gold bottomed late last year. So gold is leading a little bit, and we're just biding time, waiting for this breakout. When this breakout occurs above this, I think it's about 2090, then we're going to be on our way, and I am convinced that we're going to do something that looks like this. Now, let's say for all intents and purposes, gold is at 2,000. A move to 20 or to 5,000 is only a little over 100%. That's not much for a base this large, this many years. So 5,000 is going to be a piece of cake, just like 10,000 was a piece of cake in the NASDAQ. And $10,000 gold is not out of the question, just like $20,000 NASDAQ is not out of the question. And we've already gotten fairly close to that on the NASDAQ, even though 10, 15 years ago when I predicted that, people said I was insane and nuts and it was never going to happen. So they're going to say the same thing about gold now, and it's because recency bias makes people believe that what has happened in the past is going to happen in the future. And if an asset has been stuck for many years, that means it's never gonna move. And then what happens is they miss most of the move, and then they get really bullish, usually at the bubble top. So you're getting your best chance, obviously, was here at this 8-year cycle low, and I tried to get as many of my subscribers as possible to load up on physical gold and physical silver. Those are the easiest to hold through all of the ups and downs, along the way. Like here, lots of ups and downs. These don't look that big when you're looking at the bigger picture, but these are big percentage moves. Even this big percentage move, big percentage move, huge percentage move, huge percentage move. But overall, this is a massive, massive bull market. We're setting up for another massive, massive bull market, and gold is in the process of frustrating the maximum amount of people, getting the maximum amount of people stuck with a recency bias that gold can never do anything in the future. And that is the more of that you create, that's the fuel for these kind of moves. Again, the bigger the base, the higher in space. The longer the frustration, the more buying power to drive the bull market when the breakout occurs. And right now, gold is basically, it's kind of stuck between, let's just call it, round it off, call it 2,100 and about 1,900. That seems to be about where we're stuck. So right now we're just kind of stuck in this consolidation phase. We had a big massive move coming out of that 8-year cycle low, tested the all-time highs, and now we're stuck churning, consolidating, preparing to make another test and probably a breakout above this. My feeling is the breakout will probably occur before the end of the year, but it might be early 2024. But the most important takeaway right now is that you have to jettison recency bias, and you have to start getting prepared for the breakout when it comes, because it is going to produce a massive move. And I'll say it one last time, 5,000 is going to be a piece of cake. $10,000 gold is not out of the question.